Welcome to Cultivated Live for Wednesday, August 6th, 2025. I am Jay Rosenthal. That is Jeremy Burke. We are co-founders of Cultivated Media. He's the editor-in-chief. I'm just the guy that runs this part of the program. Today we wanted to have on the leadership team from AYR Wellness. They've certainly been in the news over the past couple of days and weeks, so we wanted to connect with them to hear it firsthand what's going on. Jeremy, I'm going to throw it to you first.
Sure. Thanks, Jay. Scott, George, welcome to the show. I think let's get started. I want to have a sort of very plain English, simple walkthrough of what's going on at AYR, the restructuring process, because there's been a lot of reporting around it. So we want to clear it up for our viewers and, hear it from you both directly.
Yeah, I mean, Scott, if you don't mind, I'll start off. I mean, in very simple terms, AYR is still present in the markets. We are we're going to go underneath new ownership. We have some core assets, Florida, Ohio, Pennsylvania, New Jersey, Nevada. Those are our core assets, and we're going to be, with our new owners, we have their commitment in really getting Virginia operational. We're excited about what the footprint looks like once we work our way through this process. And look, I mean, this whole restructure, we got here through our capital structure. And the simple process is, we are unwinding some assets that are, loaded with debt. And we're looking to make the new company underneath the new capital structure as strong as possible. Unfortunately, through this process, there are some assets that we'll be shedding. Massachusetts, our Lakewood, New Jersey facility, our cultivation and manufacturing in Nevada, a cultivation and processing center in Pennsylvania. And, we shedded almost a little over 450 employees. And that's the hardest part of this process. But, with the thought of really giving the remainder of the 2,000 employees a company in which they can operate in a non-restricted manner and really moving forward was really the key part of this restructure.
Yeah, please, Scott.
Well, and to put a fine point on it, Mark Twain said it best: reports of AYR's death are greatly exaggerated. Frankly, restructuring is rebirth. This is an opportunity for the company to actually transfer ownership to owners who are well capitalized and who are very focused on growing the business and expanding AYR Wellness now that we are shedding our debt. I mean, the restructuring process is very straightforward. As George mentioned, we started with an overburdened balance sheet, too much debt. This restructuring will wipe out a significant portion, hundreds of millions of dollars of that debt. It will be converted to equity that will be owned by our prior creditors, who will now be our new equity owners who know the industry well. And they're very focused on putting new money into AYR. George mentioned, for instance, Virginia. We're going to open up Virginia and completely roll out our footprint there. We will retain essentially the core business is not changing. Florida, Ohio, Nevada, Pennsylvania, New Jersey, all remain with some small exits. Three retail stores in Pennsylvania, a couple of production facilities in Nevada, a production facility in New Jersey. Massachusetts is the one state where the company will exit entirely. But otherwise, AYR Wellness is here to stay, and in fact will grow with the addition of Virginia. Because today we have a license in Virginia, and we have 0 stores, but soon we will have 6. And so we're well on the trail to, quite frankly, improving our position and leadership in this industry.
How much, I want to think about this more broadly as well. Like, how much growth, both for AYR and the rest of the industry, is reliant on Pennsylvania becoming an adult use, that Virginia opens up even more than certainly the 6 stores that you're talking about, Florida goes adult use, and some reform on the federal level. It's things that the industry has certainly been waiting for some time. But how reliant is AYR and or the industry, from your perspective, on these dominoes falling or falling faster? And I would even say on the Massachusetts side, like opening up, loosening of regulations, like how much is reliant on regulatory relief in any or all of these markets?
Well, I'm going to let George speak to the broader industry issue because he's an industry veteran. I'm a relative newcomer. But I can certainly speak to what it means for AYR. And the answer is AYR Wellness is fine without any exogenous help, if you will. The way the company is now constructed with its much slimmer balance sheet and much smaller debt burden is we do not depend on any legislative changes in any of our core states in order for this company to grow and be profitable. We're very excited about Virginia because today, Virginia, we're not conducting any business, so it's all growth for us there. In Florida, we're very well positioned. We're actually going to upgrade a few of our locations as part of this restructuring and improve and essentially have a portfolio of 100% profitable locations. In Pennsylvania, we're perfectly positioned at this point for profitability without a change in the laws. So all those things will be great upsides if and when they occur. And I think it's more a question of when as opposed to if. But let me turn it to George to talk more broadly about that.
Yeah, I mean, look, and I've said this before. I'm not looking for federal reform. We've been talking about it as an industry for many years, and nothing's happened. So, we really have to take a look, and and this is what we did with our debt holders on really looking at the markets that we're in, our core markets, and understanding where our gaps are for growth. When we take a look at Ohio, it just recently converted to adult use. We're just starting to get the regulations out there for pre-rolls, which is a large product category within that market. We announced, probably about a year ago, our indoor grow, which is something that we never had. We're a modified greenhouse in Florida. We're now on our third harvest. We expect that product to start hitting the market by the middle of September. So we're creating catalysts internally that will give us that growth. But again, part of the restructure was giving us a capital structure where we can operate the business for cash and really generating the revenue through a different cost profile that many operators are still struggling to deal with right now.
George, I want to pick up on that thread. Just sort of dive into that a little bit further. You're leaving Massachusetts entirely and shedding, I think Pennsylvania assets, a few key assets in other states. The decision to shed those assets, is that purely based on the financial picture of the asset, the debt load, the revenue it's generating, or are there macro things as well you're looking at? Is it something about Massachusetts as well and other states you're more bullish on? Trying to sort of understand how these decisions are made.
Yeah, I mean, the majority of the assets, I mean, it's not about the operation itself. We've had tremendous employees there. It's about the cost and the cap and the debt that we were trying to really manage through those facilities, where you have price compression in most markets. It just makes it harder and harder to handle that debt. So all of this was based on really debt associated with the facilities. And also looking at the macro market, looking down the road, Massachusetts, you have a limited number of storefronts that you could open. We had a very large cultivation. So you're leaning on wholesale. And let's face it, there was an oversupply in the market. So, not only looking at the debt, but also looking at what's happening internal in the market. Really, it was us working with our debt holders on really refining our core footprint to make sure that we can service the facility expenses with the opportunities that exist in that market.
I think the other thing to keep in mind here, and the cannabis industry is no different from every other new and emerging industry in the last 2 centuries, whether it be the tech boom at the turn of this century or the cereal business of all things at the turn of the 20th century. You have a great new product, some great new innovations, There's great enthusiasm amongst entrepreneurs and investors to get into the sector. They see the potential, they see the profit potential. And then there's the inevitable winnowing out, and the strongest companies survive. And that is exactly that's the exact dynamic that's happening in cannabis. And it's playing out a little bit state by state because of the unique nature of the industry, right? We are state by state based. And, as George said, in Massachusetts, it wasn't about the quality of our services or our products or our people, but rather it was simple winnowing out of market dynamics. Some markets are simply too saturated for the debt levels because that's the other thing. Enthusiasm leads to borrowing and investment, and sometimes over leverage. And so Massachusetts was a pretty straightforward decision for us, really, compared to our other markets.
And not to sort of put you guys on the spot and make you philosophize about your competitors, but it's earnings week, right? We're going to get another look at the financials of every big cannabis company. The last time we got that look, there was a lot of debt coming due in the middle of next year, right? And so, Scott and George, is it your view that many of your competitors will have to sort of undergo a process like this in order to right size their capital structure?
Speaking generally, absolutely. George would know some of our competitors more intimately than I might, but this is just the overall dynamic of the industry, and it's no criticism of any particular MSO or more localized operators. It's just a function of the industry and the concentration and the numbers. There are just going to be those companies that have a capital structure, a cost of capital, and a cost of operation and a quality of operation that will survive this process. And there are those that will either consolidate into others or perhaps cease operating.
Right. Can I just ask one last question as we sort of go forward? We're obviously in August of 2025. How will you know, or how will investors know, but how will you know, and what metrics will you gauge? Is this restructuring working? What are going to be the key milestones, if you can talk about it?
I'll go first, and then I'll let George come in, because George, by the way, is one of the great operating experts in this industry. He looks at a lot of very, very important operating statistics and safety factors. On the financial side, I can say, look, there's no great mystery here. What will we look at? We will look at our revenue and our revenue growth. More importantly, we will look at our operating margins and our expense levels, and see whether we continue to maintain appropriate operating margins and percentages. And then, of course, how are we doing at generating cash? What is we call EBITDA, earnings before interest and taxes and depreciation and amortization? That is a key measure of cash flow for many companies in many industries, and we're no different. And so we'll be very focused on our ability to continue to generate healthy cash flows and profits.
Yeah, I agree. Look, there's the standard metrics of grams per square foot, cash, revenue, margins. All those, they don't go away underneath the restructure. But what this allows us to do is it gives us the ability to flex a little based on the new capital structure on where we can optimize our margins. So it's a look. There's every day cannabis it's still in its infancy stage, although it's been around for many, many years. Bringing in the knowledge of lean operations, automation, that we now have the ability to really focus on those areas because of the capital infusion that we receive in order to continue to manage this business so it's healthy. And that's the key thing is it's having the ability to manage a business that is healthy instead of trying to manage a business to cover debt from the past.
Fair enough. I think that's a good place, Scott and George, to end it for today. And Jeremy, thank you for being here. We thank you for having your say and getting your message out there, because I think that's important both for obviously us, but also for our audience as well in the industry overall. So we appreciate the time. We look forward to connect with you as things progress. But thanks for today.
No, fantastic. I really appreciate you guys taking the time to talk to us.
Appreciate it.
Thank you both.
Thank you.
Likewise. Thank you.
Thank you.